Hello my dear students, welcome again. As I have already told you in the previous video that in some couple of videos I'll try to solve a particular problem related to company financial statements. So this is a one sample question we will try to solve in this couple of videos. Okay. So to make the video short, we have to do it step by step. Okay. So as you can see in this problem we are given a trial balance of PBS Limited, that's a corporation or company, and it is the trial balance at the end of December 31, 2018, which is the end of company's fiscal year. That means the company maintain a January 1 to December 31 accounting period, right? So to prepare the financial statement, we need a trial balance, and that what is given here. First of all, we are given a trial balance of PBS Limited. And it's not like the just trial balance will be enough. You will be also given some additional information that will have some impact on the sum of the values of these particular accounts. Okay. So after getting the trial balance and after incorporating the effect of some additional data, we can prepare multiple step income statement, statement of owner's equity, and classified balance sheet for BBS Limited. Okay. So again, I'm telling you that we'll do it step by step to keep the video short, and in this particular video I will try to give you some idea about how to incorporate the additional data in our financial statement. So we'll start with the number one. The additional data of number one additional data is the company is under 42.5% tax bracket. What does it mean? It means that since it is a corporation, it has to pay tax on its income, and it is under 42.5% means that if the company earn $100 profit before the tax, they have to pay $42.5 to the government as tax, and this tax is a major expense of a corporation. Right. So this is the additional information. So tax is an expense, we have to use that. So where we write the tax expense? I hope you remember from the previous video. We write the tax expense in this particular segment. After we calculate the earning before taxes by deducting the cost of goods sold, operating expense, other expenses, and we get the earning before and interest, we get the earning before taxes, and whatever earning we generate before taxes, we have to pay taxes on that amount. So we have to pay taxes at the rate of 42.5%. So the 42.5% of this earning before tax income is 1,13,815. So this is the tax actually we have to pay to the government, not now but very near in the future. So this is the tax we have to pay from the profit we have made in this particular year. So this year it is given that this is the year 2018. So in the 2008 from the 2018 profit we have to pay 1,13,815 to the government as taxes. Just think about that. Right now we have just calculated the tax, right? Have we paid the tax to the government? No. But we have calculated the tax, and we know that this tax, according to the accrual principle, this tax we should record it as an expense immediately. And we know that whenever we record any transaction, we have to, for equal amount of debit, we have to do equal amount of credit. Think about that. In which of the part of the statement it will impact again. Since you are calculating your taxes and you know that you have to pay the taxes, and that actually increases your liability. Now, since you have generated profit, you have some liability to the government. Now we have some liability of 1,13,815 to the government that you will have to pay within 1 year. That tax expense will also be inputted to the current liability portion of your liabilities and owner's equity statement. Tax payable 1,13,850. Why? Because this is the tax we have to pay, you are liable to pay, right, from the profit of this year. So, and since you will have to pay within 1 year, you have to write it in under the current liability portion. So A1 means additional information 1, related to additional information 1. Okay. So remember one thing, whatever additional data will be given, that data will at least affect two parts of your financial statements, right? Okay, so we are done with the tax and tax payable, and now move to the second one. The interest on the debentures has not yet been paid. What is debenture? Debenture is a one type of bonds that are unsecured. That means they have less security than the other type of bonds. Okay, so here we can, if you check thoroughly, we can see that we have a debenture which is known as 8% debenture having a value of 1 lakh. 8% debenture 1 lakh means that you have to pay 8% interest against the debenture every year. So what is the 8% of 1 lakh? 8,000. That means we have to pay 8,000 as an interest expense every year against the debenture. So it is an expense, right? And according to the accrual principle, we have to record this expense. If you do not record it, our income statement will not be accurate, right? So where the interest expense goes in the financial statement of a corporation? Yes, we remember it, right? It actually goes just before the taxes. We just talked about in the previous long video, right? So after you calculate the earning before taxes, you have to deduct the interest expenses of 8,000 in this case from here. 8,000 minus interest expenses. Okay. Again, the interest expense you have incurred, but you haven't paid yet, right? The interest expense you have incurred, but you haven't paid yet. So that becomes your liability. So where will you write this liability? Under the current liability portion. Interest payable of 8,000 will go to the current liability portion again. Again, I am telling you that every account will impact at least two sides or two part of your financial statement. So that's the second one is very simple. What about the third one? The third one is that the company has declared 10% cash dividend. So what is cash dividend? Cash dividend is if company decide to pay some of their profit or some of the retained earning to the shareholders or stockholders as dividend, or some of they distribute some of the cash from their profit to the stockholder, that is known as cash dividend. And the company has declared 10% cash dividend. What is that? On which amount will charge the 10%? Very simple. Company normally provide the dividend on the par value of the stock, not on the total paid in capital, right? The company pay cash dividend on the par value of the stock means that since the company has declared 10% cash dividend, we have to check what is the par value of the common stock. Exactly. The common stock has total par value of 1 lakh. It has additional paid in capital, but we will not calculate the additional paid in capital. We will calculate the 1 lakh, we will calculate the dividend on this 1 lakh value. Remember that very carefully. We calculate cash dividend or dividend on the par value of stock, not on the total paid in capital. Okay. So 10% cash dividend we have declared. We will calculate this on this value. So how much dividend the company has declared to pay? 1 lakh multiplied by 10%, which is equal to 10,000. So 10,000 cash dividend the company has to pay. And what impact does cash dividend has on the financial statement? Again, you remember that, you should remember that cash dividend will go here. It will reduce your retained earnings, because retained earning means earning you have accumulated till now, and whenever you pay away some of that earning as dividend, that will reduce your retained earnings. So it will be deducted from your retained earnings value, so that you get a new balance of your retained earnings. Okay, great. So you have declared the dividend again, but have you paid the dividend yet? No. Today you have just declared it, and whenever we declare something, that becomes our liability. Now the company cannot take back his words that okay, I have decided that I will not pay anymore your dividend. No, because you have declared, right? So whenever company declared, that becomes their liability, and that will be part of the current liability too. The dividend payable from the additional information 3, that will also be inputted as a current liability under liabilities and owner's equity segment. Okay, great. And the number 4 transaction or additional information we got is that this company has to charge depreciation on a reducing balance method. This you have learned from chapter 10, right? Reducing balance method, declining balance method, and double declining method, they are all the same. That means, and they have already given you the percentage of how much at what percentage you will charge the depreciation on your assets. So for the machinery, you will charge the depreciation at 20%, and for the equipment, you will charge the depreciation at 10%. Okay. So what is the difference between straight line and the double declining or reducing balance method? Very simple. The straight line, we charge the depreciation on the book. We charge the depreciation on the cost of the asset or depreciable cost. Actually, depreciable cost. But in terms of reducing balance method, we charge the depreciation on current book value of the asset. And how we get the book value? Suppose this is a machinery. The machinery book value is not 85,000. It is actually 85,000 minus 22,000. So 85 minus 22, how much we get? 63,000, right? So 63,000 is the book value at this particular point of time, or at the start of the year. Sorry, not at this particular point of time, at the start of the year of this particular machinery. So since we are following the reducing balance method, we have to charge the depreciation on the 63,000, not on the 85,000. Similar thing goes for the equipment as well. We are also following the reducing balance method on the equipment too, but the equipment is percentage applicable for the equipment is 10%. So first we have to calculate the book value of the equipment. 48,000 minus 6,000, we get 42,000. Then we will charge depreciation on this 42,000 book value. So remember that, don't make mistake. If in your exam, if it is mentioned that it is straight line method, you have to charge the depreciation on this amount. But if it is mentioned that it is declining or double declining or reducing balance method, you have to charge the depreciation on the book value of the asset. And this is not something new, this you have learned from chapter 10. Okay, so what we have done there, depreciation expense is an operating expense, we know that. So we calculate the depreciation expense, machinery 85 minus 22, we get 63,000. And if we get 63,000 into 20%, we get that depreciation expense for the machinery 12,600. And for the equipment, our book value is 48 minus 6, which is 42,000. And if we charge the depreciation on the 42,000, our depreciation expense for the equipment becomes 4,200. Okay, great. And we know that whenever we charge depreciation, the accumulated depreciation account is created or it increases, right? So you can see here, this is our accumulated depreciation account. Previously it had a value of 22,000 that we have just seen now, right? And for this year depreciation, it will increase by 12,600 more. So the accumulated depreciation will become 34,600, and that will be deducted from the machinery to get the new book value of the machinery. Similar treatment will be done on the equipment as well. So previously the accumulated depreciation of the equipment was 6,000. Now for this year depreciation, 4,200 will be added, and the new accumulated depreciation value will be 10,200. Okay, great. So this is how it impacts. And last one is the very simple one. Supplies on hand total 2,000 that we have learned from chapter 3. It is an adjusting entry. So in our record, it is showing that supplies is having balance of 6,200. But and actually at the end of the year, the record is the physical verification shows that the supply is only 2,000. That means we have used 4,200 supplies during the year, right? So that 4,200 supplies will be termed as supplies expense, and supplies expense is an operating expense. So first of all, we will write the supplies expense under the operating expense portion, right? So we will write it here, supplies expense 4,200, and you know that the previously the supplies balance was 6,200, but it is not right. Right now the supplies balance is only 2,000. So in the balance sheet, we also have to make some adjustment. In the balance sheet, under the current asset part, we won't write 6,200. Rather, we'll write the new balance of supplies, the accurate balance of supply right now, which is 2,000. So with this, we have incorporated all the additional information to our financial statement. In the next couple of videos, I'll try to finish the whole statement step by step. But first one is the more important one, it is the additional data. If you understand how to incorporate the additional data in your financial statement, you are very much good at learning this financial statement. Okay. Okay. So with this, I conclude this part of the video, and in the next video, I'll try to complete this financial statement. Next couple of videos actually, I'll try to complete this financial statements. So be with me. Inshallah, we'll meet soon.